Great. The disclaimer's up. You want to start with that?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. If you need professional advice, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer. And with that, I think we'll get started.
All right. We're going to do a Q&A today, right, Dee? So anyone who has a question, it works really well if you come on live. I put the link to the Zoom meeting in the YouTube chat. So if you have a question, any question concerning Market Chameleon, the product, come on over, raise your hand, or send me a message in the chat that you want to ask a question live, and we'll bring you over, and you can, X out your video so there's no video. Just use your voice if you feel comfortable with just your voice. But it is super helpful for everyone if people have questions to ask them live. Other than that, you can put your questions in either the YouTube chat or the Zoom chat, and I will try to decipher them and get them to Dima. With that, Dee, you want to, what's going on in the pre-market?
Yep. Thanks, Will. Yeah, so I think we'll start out while we're waiting for any questions to come over. We'll start out with the pre-market report. I'll continue on some of the option reports we didn't cover last week, we didn't get to, so I'll continue on that. And if we get questions, then I'm just going to focus on the questions once they come through. So let's start. Yep. So let's start with the pre-market report, and these are stocks that are trading in the pre-market hours. We have our most active list, our biggest percentage gainers, biggest percentage decliners. I'm going to come down here. I see that 63 stocks made our percentage gainers list, 31 on the percentage decliners list. So we got about a 2-to-1 favoring a more bullish bias at the open. I'm going to take a look at the S&P 500 stocks to see how those are lining up pre-market. So let's come over here to the ETF filter. I'm going to drop that down, select SPY. This will then filter out this list based on S&P 500 components that are part of the SPY. And I have 7 stocks that made our percentage gainers list, 2 on a decliner list. So looks more of a positive bias at the open, but these lists not very big. We've seen them much bigger usually when we have a very big positive day or going the other way. But nevertheless, a little bit more bullish at the open. So I'm going to probably just then navigate towards some of our option reports, unless you have any specific.
Dee, before you get started, Lauren is asking, when you're doing the option screener, so those prices and that data updated every 15 minutes as well during market hours?
Yeah, so when you guys are looking at the options, we have a lot of different reports here. When you guys are looking at it, all the market data is at least 15 minutes delayed. So the market data itself, that's how we license it. We don't control it. Market data and prices are actually, it's not like public information that you go like to some government and they give it to you. They're owned by the exchanges, right? So the exchanges own all those quotes, prices, and you have to go and make agreements with them and licenses to use that data, display it, distribute it, and our licenses that it's on a 15-minute delay. When it's on a 15-minute delay, we actually get to do more things with it than it was real time, a little bit less restrictions on it. So the market data comes in 15-minute delay. It goes into our database. Once it hits our database, we perform different types of analytics on that data so we could get you, an analysis of the data. So it's different than display. You guys, a lot of times you might see from a broker, you get market data that's just displayed. Sometimes you have to download an app on your computer, and by downloading the app on your computer, all the processing is done on your computer. They just kind of push out a price. That's not what we're doing. we're letting the analytics, we're doing the heavy duty stuff in our servers because there's a lot of analytics probably would not be able to handle it on a laptop, and then what you do is just access it. So the market data, 15 minutes, at least 15 minutes delayed, but then there is a process to then run analysis on it, and different reports have different timers based on how intense the analysis is. So, I say at least 15 minutes delayed, but then you give it time to process that data. Okay,
Sounds
so
good. That answered the question.
And this is a research platform, right? You're doing research, looking at valuations, risk reward. This isn't an execution system where you're trying to, execute a trade immediately, like where you need a real time. This is more of like you're using it for an analysis. So it's a system that you would run side by side with your execution system. Big difference between execution and research. Some people like just conflate and think that the execution system is their research, looking at flickering quotes and trades is their research, but no, that's not how it works, right? You got your research platform and you got your execution platform. That's standard, right? So think of it that way. This is what you would use to conduct and do your research. Does that help answer the question?
Yep.
Okay. So I'm going to kind of move on unless there's a follow-up on that. So let's come to the options report. So here, let's take a look at the Straddle wing back tests. And this is kind of like will probably be a good example of research. So what this report is doing over here is taking a look at a week to week, right? It's recording a week to week performance of a couple different option strategies. So one would be, for example, Straddle. Like how does a Straddle tend to perform if you bought a call and the put, right, at the beginning of the week? Let's say you waited, and we wait till like 10 o'clock where things kind of like tighten up. We take a snapshot and say, well, if I bought a Straddle in the beginning of the week on Monday and held it to Friday, right, all these different, Apple, Microsoft, how did that tend to perform? Is it on average making money, losing money? How frequently does it make or lose money? And what are the average returns, right? So that's kind of what we're looking at. How does the market tend to overprice the Straddle, or does it tend to underprice the Straddle, right? And we could do that, for all the list of stocks and kind of compare those. And we could do the same thing with an out of the money call. We could do the same thing with an out of the money put. And we could change the strategy as well and say, well, besides holding that option, what if we didn't take a directional bias from day to day, but we hedged our delta? So as the options move, there's a gamma, there's also delta to it. And what if we hedged it and smoothed out our returns over time by trading the volatility instead of direction? So how did that compare to just plain, letting the options go, right? So let's just take a look at a Straddle. So I'm going to come over here. We're looking at, right now it's set to at least 12 weeks. So we got this set to 12 weeks, which is a pretty decent time because you want to kind of see how it's performing in the most recent history, and that's kind of what we're trying to tell. Are the options currently tending to being a little bit underpriced or overpriced? That's what this test is about. I'm going to pick the strategy. Let's just do at the money Straddle. So by picking that the money Straddle, we got a couple different, you could see for Apple, there's 3 different ways to look at it. So remember, Straddle, buying a call, buying a put. Is everybody okay with that? If you have questions, let me know. But that's a non-directional strategy. And what can you do with it? Well, You could buy the call, buy the put on Monday and wait till Friday. And if the stock moves enough, it'll be profitable if it moves enough to cover the total cost of that premium. And if it doesn't move enough, you're gonna lose what you paid for that premium or whatever portion. So that's one way of trading a straddle. Another way is a straddle, you don't always have it at the money, right? Like, so perfect straddle will be the stock is 100 and you have strikes that are exactly 100. You buy a call, you buy a put, and that would be, perfect straddle. But a lot of times the strike, you have a strike of 100, but the stock is like 101, which means that the call will be worth more than the put, right? And so you don't have it. So then you have a little bit of a bias there, right? You're a little bit long. So you want this stock to actually go up. You're better off the stock going up higher than going back down. So to neutralize that, you could do a delta neutral straddle, right? You could figure out your delta. Well, it's in the money a little bit, so I'm going to sell some stock, get it back to delta neutral, and then hold it till the end. So that's a delta neutral versus just unhedged, just buy and sell. And then you got this guy over here, which is saying every day the stock moves, right? Because if I'm holding it for a week, well, the stock is also moving day to day. Some days it could go up, sometimes it could go down, sometimes it could go up, then down. So instead of just waiting till the end of the week, I'm going to re-hedge the new deltas at the end of the day, each day. And that's more of a professional, how they would trade volatility. You would take the option pricing model, figure out your gamma delta risk, and trade those deltas against your position. So it's a delta neutral strategy, re-hedged daily at the end of the day, right? So here for Apple, I got 3 of these, for Microsoft, Google, and so forth. And if we want to just look at a particular one, I think here you could just say unhedged, delta neutral, or daily re-hedge, but let's just keep all of them for now. So here are the observations. Now, if you want to just view the data, so this is for Apple, unhedged, at the money straddle. This is Apple's market cap, average daily option volume. This is the money straddled, the average bid-ask spread. So you could see these markets are tight. In Apple, they're more liquid. So those markets are much narrower, the bid-ask spread. These last 12 observations, so I could view them by clicking on there. I get the last 12 weeks and what happened. But let's just come up here first and see the summary statistics. So these are the summary statistics, and this is what it's saying, that in the last 12 weeks, we're approaching it from the buy side, that straddle was profitable 42% of the time, right? So basically 4 out of 10 times it was profitable, 6 out of 10 times it was not profitable. So what did it return though, right? Because the times it was profitable, right? When you're buying options, you have unlimited, theoretically you have an unlimited reward, right? The options could just keep going and going and going. And if you're long, you keep profiting. So even though they're only profitable 42% of the time, which from the long side seems reasonable, what was the average return? So here it turned out that on average, week to week, the average return was 8%. So they were actually profitable from the long side in Apple from Monday to Fridays. Okay. And then what is the median return? So that return right in the middle, that was negative 38%. So what this is telling me that there's probably 1 or 2 really big weeks in there that pulled that average up. So we could come down here, right, and take a look at, like over here last week, it returned 113%. Here, the week of November 19th, it returned 245%. So you could see that there are a couple weeks there that it really brought up that average, right? So that's what this is telling us, that that's why it turned out in the, on average, 8% return. Standard deviation, this is important as well because this tells us from week to week the variability of returns, right? So the higher the standard deviation, that means those returns are moving around. Some weeks you have a huge, return one way, then you have a small return. So it's the variability of week to week. So standard deviation, very important. We see that 101%, it's a very, and we could come down here, right? And just see like from week to week, very big deviations in returns, right? So it's not just kind of measuring the consistency of it. So a lot of variability in returns. The worst return, 100%. So in one of those weeks, whatever you bought that straddle, you lost entire premium, right? The best return, 246%. So whatever you bought, you got 246% return. So this is just giving us a quick summary of how that straddle performed, the returns, and the variability of those returns, right? And that's kind of here the sharp. It's another way of just saying, well, what is the return divided by the variability of the returns, right? So think of it this way: you want your average returns to be high, and you want your standard deviations to be very low, and that makes this ratio go up higher. So the higher this is just saying that there's more consistency and less variability on your returns. Okay, so down here, that's one. So that's an unhedged straddle, just basically going in or buying it, holding it, and this is how it performed in the past, right? Just looking at how this did in the last 12 weeks, if we're trying to determine, how are they lining up today, and how much weight do we put to the past? This here, that's a delta neutral. So that's hedging the original straddle. And over here, this is more from a professional hedging strategy, right? So when we're just looking at the volatility, we're trading the realized volatility versus the implied volatility. And here it's more interesting. What this is saying is, and this would be probably more in line with the stats that you expect, is that it was a winner 33% of the time, so 1/3 of the time, and on average you lost 8%. So what does that mean? That the volatility itself, the implied volatility itself, was probably correctly priced, and that if you trade just the volatility, you would lose on average 8%. So why is this one higher? Well, you didn't trade the volatility, you just let the option go, right? You just let it go, and you said wherever the stock. So basically, then this is more reliant on the path of the stock, not the movement, but didn't move away enough one way or the other. Does people get that? Hopefully, right? And it depends on what strategy. I think you're on mute, Will.
Sorry, D. Yeah, it seems like we're not getting many questions back on it, so it seems like the explanation is spot on. Okay,
and this is more, a little bit more advanced than we typically do. And we don't usually reference this, so I'm trying to go a little bit slower, see if questions come up. But because we're adding an element of there's a hedging involved in these options, right? We're daily hedging of deltas. Let's take a look at
while you're on the straddles. Trevor just asked a question. He's asking, is there a way of determining if the straddle value or cost is increasing or decreasing?
Well, you'd you would look at the implied volatilities from day to day, right? There is, that's what the implied vols are helping us do, right? So if we're benchmarking implied volatilities, we could see it. But within here, remember, this is, you're strictly saying that Monday to Friday, right? Doesn't matter. We're not looking at intraday. We're just saying we start day Monday all the way to Friday. How did it do over that week? So we're giving it a little bit, we're expanding that time a little bit. So it's not just a 1 day, but more of a 1 week period. Okay,
Perfect.
but if you're looking day-to-day implied vols, then you'll be able to tell if it's increasing or decreasing. Let's take a look at let's look at the S&P 500. And let's take a look at the unhedged straddles. So here now I got the S&P 500 unhedged, and we could kind of just compare them versus each other. So we see, Microsoft did from the straddle perspective, looks like that returned much more than Apple, and it's got a higher Sharp. Got Google at 12%, Amazon 7%, Tesla 47%. So to me, it looks like Tesla in the last 12 weeks had very big movements. Facebook, that was down 26%. NVIDIA up 56%. Again, you'd want to go take a look at what transpired, what happened in there, but now we're getting a sense of how they did relative to each other, right? Let's take a look at the hedged. So the hedged, daily rehedged, this is more of, was the implied volatility tended to be a little bit overpriced or underpriced relative to the realized vol, right? So we're comparing the beginning of the implied vol, and if we traded according to the Black-Scholes model, how do we do by the end of the week? So here we see that Apple, on average lost 8%. Microsoft on average made 7%. Google 13%. Amazon 12% up. NVIDIA 27%. So this is, here, maybe that's interesting. NVIDIA tended to be underpriced, right? So it had much bigger movements than the options anticipated. Visa also, the options underestimated those realized movements, 67% of the time, average return 39%. And so it looks like Visa, actually, MasterCard. So maybe something's been going on in those credit card, they're very similar industries. And I'm just seeing if any other ones stick out at me. Adobe 33%. So, something that is just pointing out, right? Credit cards, those implied vols have been tended to underestimate the actual realized vol. Here we got, what do we get? 58% of the time it underestimated in this is MasterCard, I believe. Let me just open this up. That's MasterCard. Visa, 67% of the time. So those from the buy side of options, those tended to do well. From the sell side, Johnson & Johnson, overestimated the implied vol here. And we could actually sort these as well. So if I sort these, it'll give me the high searcher. So I could sort any of these. Or let's see the ones that were tended to be the most underestimated. So NVIDIA, ST, OGN, American Express, Intuit, NASDAQ, that's telling you the percentage of the weeks that the implied volatility was underestimated the move for that week. Is that making sense to everybody? I could move on or stop
There was one question you may have mentioned delta, that it was delta neutral or hedging your delta. Could you just explain that to Wes?
So when you're trading an option, right? An option has a delta, a directional bias, right? A call, if you're buying a call, then and you do nothing, then you want the stock to go up because then you have a positive delta. If you're buying a put and you do nothing else, you want the stock to go down because that's then you have a negative delta. It's like shorting the stock. Now, with an option, you have different components. You have a volatility in there as well. So if you hedge that delta, and I'll show you, maybe I'll go to an option. There, let's go to Apple. So I'm over here. Let's just come over here. So a lot of you guys probably heard of deltas. So these are the calls on this side. These are the puts on the right-hand side. And you can see that as the calls go up in strikes, they have deltas and the deltas go lower and lower. And for the puts, they have a negative delta. And as the strikes move, the deltas decrease. So let's say you have a call here, the 195 call, that has a 20 delta, right? So what does that mean? That according to Black-Scholes model, right? Here's the 20 delta. According to Black-Scholes model, if everything else stays the same, the implied vols don't change. We don't. Let's say the stock moves $1 in the next minute, and nothing else changes. So in a minute, you don't have a lot of time decay. Let's say the implied volatility stays the same. It's assuming right now everything else stays the same. Then this option is expected to increase by 20 cents for when the stock goes up $1, and it's expected to decrease by 20 cents if the stock goes down $1. Okay, so it goes up $1. This will go up by 20 cents, right? So you'll be happy. If it goes down $1 and you bought it and it goes down by 20 cents, you're not going to be that happy.
You'll be a little sad.
You'll be a little bit sad. But
hey D, you've gone underwater a little bit, but we only got a couple minutes left. I don't know. Do you want to come back in, or do you just want to?
Should we just maybe then continue the delta?
Actually, you know what? It's gone away. Whatever you did, just stop it. Your sound is good now. All right. Why don't you finish up?
All right. So, but let's say that you really bought this option because you just think that that theoretically it should be worth more based on the volatility of the stock, right? That there are too many sellers. They underestimate the true volatility of the stock moving around. So you want to take the volatility bet, not the directional. So let's say you bought 10 of these options, all right? So you bought 10 of these options, and what is our delta now? So our delta is 200, right? Meaning that if I bought 10 of these options, it'll cost me, $1.85 times 10 times 100. But if it goes up, I'm going to make $200. If the stock goes up $1, I make $200. If it goes down $1, I lose $200, right? But how do I offset that? Well, I'm going to hedge my deltas, and I'm going to say sell short 200 deltas. So see this chart, payoff diagram, it's going to look differently. It's going to look somewhat like this now. And now if the stock goes up $200, I will make $200. I'm sorry, if the stock goes up $1, I'll make $200 on my call, but I will lose $200 on my stock. So I break even, okay? Now, if the stock goes down $1, I lose $200 on the call, but I make $200 on the stock. So I break even. What's the point of that? The point of it is on the direction, I'm breaking even. But if the implied volatility increases, then my option price will increase. Or if the volatility keeps moving back and forth, I'm going to rehedge my deltas, and I'm going to make more money scalping the stock back and forth than I do in the decay. And I would have to expand on that, but that's how the Black-Scholes model works. In a succinct way.
We did have a good question on Zoom. It was long and a couple different questions. I wanted the person to come on live. He didn't get back to me. But he was asking, and something maybe to think about tomorrow. I want to see relative strength based on regular market hours, moving in the opening gap. If a stock gaps 5 points and doesn't move any further versus one that trades up the 5, points during the market hours, is there any way to view stocks that move during market hours to 5% and back out the ones that have gapped up in the pre-market? It was a long question, and I'll also ask some things about broken wing butterflies and ratio spreads and analyzing them. But it was a large, long question. But do we have anything to screen for stocks that move during the market hours versus ones that gapped up during the pre-market? I guess that was the first question he asked.
I get you can screen for things like, I think in the stock screener, you could screen for gaps or intraday. So over here, let me see here, price performance. Let me just see here. Might be under technical. So here's the gap, right? So here you could screen just this is the gap move, and this is from the open. So this is intraday. So if you're looking just, let's say this is 4% at the morning, it gapped up 4.6%. Remember, these are Fridays, we're not open yet. And then it gained another 1.9% intraday, right? So that's what the total return was for the day. But this breaks it down between the percentage move on the gap and then the percentage move from the open, to the close or to the most current price.
Perfect.
Yep.
Perfect. Awesome job, D. Way to fight through the sea monkey, and I don't know what happened, but you were able to get the mic back working. That was great. And
awesome.
Really helping the Chameleon community. Thanks, my friend.
All right. Thanks everyone for joining. Stay safe out there. Have a good trading day. Hope to see you guys tomorrow.
Awesome. And actually he came back. He was on the show and he said, great job and great answer. You got it, D.